Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Bryon Lake, Global Head of ETF Solutions at JP Asset Management. We're here to discuss ETF trends in 2024 and the continued growth that we're seeing in active management. Bryon, it's great to see you as always. Welcome back to TradeTalks. Let's talk about this active management. That really seems to be certainly one of the key themes here this year.
Yeah, absolutely. I mean, we know ETFs are growing fast, right? There's never been a rolling 5-year period where ETF assets haven't doubled. That equates to a 20% cumulative average growth rate year after year after year. So ETFs are growing big. Within that, active is growing even faster. Over the last decade, active ETFs have grown at a 50% cumulative average growth rate to become a pretty substantial part of the overall marketplace. Last year, active ETFs accounted for over 20% of the net flows into ETFs. So investors are looking for active investment delivered through the ETF technology. And actually this year started off on the same leg. About a third of flows have gone into active ETFs.
Investors are really rethinking the entire fixed income strategy as well. Why do you think we see that shift there?
Well, obviously that's heavily fed and rate driven, right? 5 years ago, there was no yield to get. It was relatively straightforward. You kind of just had to build your portfolio around what was there. Now we have a rate environment where bonds can actually contribute pretty substantially to the performance of a portfolio. So if you look at, for example, we've got an income strategy, ticker JPI, JPIE. The idea is to give you high yield like yield with lower volatility. It's got a 6.8% yield to maturity with a duration of over 3 years, meaning you can expect to get about 6.8% a year for the next 3 years. And if we look at what we think we get from equities, the equity risk premium is kind of like 5-6%. And so you can have the safety of bonds with the returns of kind of 6.8%, that's really attractive. And so we're seeing investors rethink their entire fixed income allocation. Think about a 60-40 portfolio. That means 40% of the portfolio is in bonds. And I don't feel like we talk about that enough. And so having the capability to get active strategies through the ETF wrapper on the fixed income side is a big differentiator. And active outperforms on the fixed income side. I mean, JPI, the strategy I mentioned earlier, outperformed its benchmark by 150 basis points last year, 1.5%. We have a core plus bond strategy, JCPB, same thing, outperformed its benchmark by 200 basis points, 2%.
That's tremendous. And it makes sense too. The individual investor cannot replicate these portfolios. One, it requires a certain skill set, and two, it's not cost effective. So I get it, like fixed income, active makes sense. What about concentrated active performance to drive outperformance? That seems to be somewhat of a newer theme this year as we think about concentration like the Mag 7 as an example.
Yeah, everybody's talking about the Mag 7, and obviously the way you want to think about it is what's the outcome that an investor is looking for? If you're looking to get a higher outperformance number, the way to do that is to differentiate from the benchmark. And so you might go more concentrated in a couple names that you think can drive that performance going forward. So to me, it's more about what's the investor trying to accomplish within their portfolio, and then matching that up with a security or an ETF that's actually going to drive that outperformance. So we've seen the Mag 7. I don't know, do we think that this is going to continue in the same way? What type of risk are we embedding in our portfolios when we've seen a company like NVIDIA that's now worth more than Amazon?
They put on like a market cap of GM every day. I mean,
right, and so like what, does that go forever? Will there be a little bit of normalization? What about the other 493 in the benchmark? These types of things. And so, as always, investors should think about what their objective is and then see what ETFs are available to them and then use those to build the portfolio that they're looking for, not just chasing returns.
All right, Bryon, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.